All right, today we're going to tackle something absolutely fundamental to the market's price, but we're going to look at it through a lens that I guarantee you probably haven't considered before. We're going to step away from the usual charts for a minute and take a little trip into the strange and fascinating world of quantum mechanics to understand what's really going on.
It all kicks off with a question that every single trader has asked themselves at some point. You're watching a stock, it's climbing, and then it just stops. Like it hit some kind of invisible wall. Or maybe it's falling, and then boom, it just bounces off an invisible floor. So what are these levels? And more to the point, how real are they? That's the mystery we're digging into.
So, first things first, let's ground ourselves in the traditional way of looking at all this. This is your technical analysis 101, right? The idea that the market is basically a battlefield, and the price is the territory everyone's fighting over. On one side of this fight, you've got support. The easiest way to think about it is like a floor. It's a price point where the buyers, the bulls, are just waiting to jump in. They see a good deal, and there are enough of them to create a wave of buying that stops the price from dropping any lower. And, of course, the opposite of that floor is the ceiling. We call that resistance. This is the price level where the sellers, the bears, decide to take control. They figure it's a good time to cash out, and their selling pressure is enough to stop the price from going any higher. It's a cap. So, what this really boils down to is a constant tug of war. The bulls are on one side, creating support by demanding shares when prices are low, which pushes everything up. And the bears are on the other, creating resistance by supplying shares when prices are high, which pushes it all back down. It's a pretty elegant model, really, just pure supply and demand. Now, here's where it gets really interesting in this classical view. These levels, they seem to have a kind of memory. When a price breaks down through a support floor, that exact same level can turn into the new resistance ceiling if the price tries to climb back up. It's like the market psychology totally flips. What everyone saw as a bargain is now seen as an expensive spot to sell. Okay, and this is where our nice, clean little model starts to get, well, messy. Because if you've ever actually tried to draw these lines on a chart, you know they're almost never perfect, right? The price might dip just a tiny bit below support or poke its head just above resistance. So you have to ask, how precise are these invisible walls really? And that question actually leads us to an even deeper problem. We talk about the price of a stock like it's this one solid concrete number, but the reality, it's a lot fuzzier, a lot more uncertain. The truth is, support and resistance aren't these razor-thin lines. They're more like blurry zones. And this fuzziness isn't just because we're bad at drawing lines, it's actually baked right into the market itself. At any given moment, there isn't just one true price. The most obvious, tangible proof of this fuzziness is something we call the bid-ask spread. It's just the gap between what buyers are willing to pay for something, that's the bid, and what sellers are willing to sell it for, that's the ask. For a super popular stock, it might be just a penny, but for something less traded, like an out-of-the-money option, oh boy, that gap can be a canyon. And let's use a real example from the material we're looking at. Imagine an options contract with a bid of $5 and an ask of $9. I mean, that is a $4 gap. That's not a single price point. It's a massive zone of possibilities. Which, of course, brings us to the real problem. If you're holding that option, what's it actually worth? Is it worth $5, 9, maybe 7, right in the middle? The totally frustrating answer is it's kinda all of them and none of them at the same time. Not until a trade actually happens. So how in the world are we supposed to make sense of that? Well, to solve this little puzzle, we have to take a big leap. We need to jump into a field that you would think has absolutely nothing to do with finance. We need to start thinking like a quantum physicist. Now, stick with me here, because this is the big idea. What if all this price uncertainty isn't some flaw in our models, but a fundamental feature of the market itself, just like the uncertainty that sits at the very heart of quantum mechanics? Okay, so let's start with the core concept from quantum physics, superposition. It's this wild idea that a particle, like an electron, doesn't have one definite location until you actually measure it. Instead, it exists in this probabilistic cloud of all possible places it could be at once. Sound familiar? That's our bid-ask spread. The options price isn't really $5 or $9. It's existing as a cloud of all the possible prices in between. So what makes that price become real? Well, in the quantum world, the act of observing or measuring a particle forces it out of that fuzzy cloud and makes it pick one single spot. They call it measurement. And in our world of trading, our measurement is executing a trade. The second you place an order and it gets filled, you collapse that cloud of possible prices into one single concrete number, the price you actually paid. And this table here just lays out the whole analogy perfectly. Your trade is the measurement. The environment that influences this collapse, that's everything else going on, the market makers, the liquidity, the breaking news. And the actual process of that cloud collapsing, they call it decoherence, that has real costs for you. Things like slippage or only getting part of your order filled. That's the uncertainty turning into a real, tangible thing. Okay, this is a seriously cool way to think about things, but let's be real. What's the practical payoff here? Why does thinking like a quantum physicist actually make you a better trader? Let's get into how this actually works in the real world. Well, the first thing is a massive shift in how you see things. This quote from the white paper says it all. The mid-price, that number right in the middle of the spread, it's not some guaranteed fair value. It's just one possibility in a cloud of probabilities. You're not trading certainties, you're interacting with the system of odds. And that leads to some really critical, practical changes. You start to see that hitting buy or sell isn't just a transaction. It's an action that literally reveals hidden costs. You get that market makers aren't just background noise. They are actively shaping the probability field you're playing in. And your risk management, it suddenly has to be about more than just price targets. You have to account for the width of the spread itself, because that spread is your risk. Think about something you might do all the time, like rolling an options position. With this new model, you're not just swapping contracts. You are kicking off a quantum transition. You start in one fuzzy cloud of uncertainty, your current options wide spread. Then you interact with the market, your execution, and you end up in a brand new fuzzy cloud, the spread of the option you just rolled to. The real cost of that move is all about how you navigated that transition. So if you take one thing away from all of this, let it be this. The old school view of perfect lines isn't necessarily wrong, it's just incomplete. The real next level insight is to stop looking for perfect, solid lines of support and resistance and to start seeing the market for what it truly is, a shimmering, uncertain cloud of probabilities. A cloud that you, the trader, collapse into a single reality with every single order you place. And that really leaves us with one final question to think about. Next time you pull up a chart and get ready to place a trade, just ask yourself, are you trading the illusion of a solid line, or are you embracing the reality of the probabilistic cloud? The answer just might change everything.